Good day, trader. Stacey Burke from Stacey Burke Trading. Today, we're going to review 3 trades that I took and go over the difference and understanding of those 3 trades, the basic setups, the thesis, and then the tactics and executing those trades. A lot of questions asking me about, well, you sold the high yesterday and today you bought the high and it's 3 levels. And so we're going to clarify that. We're going to go over some things, and I'm going to recommend that traders get these books. You don't have to get all of them. You can get one of them. You can get all 3. I would highly recommend reading at least one of these. Edwards and McGee, Technical Analysis of Stock Trends. Schabacker, Technical Analysis and Stock Market Profits. Or Peter Brandt. Follow him on Twitter or read his books, Diary of a Professional Commodity Trader, or the Classical Trading Commodity Patterns with Classical Charts. All classical charting patterns, and we'll show how I apply that, but just the basic knowledge of geometry and classical chart patterns can make a massive difference in helping you identify best trading setups. Then I emphasize the timings. Asia 8 to 11 p.m. New York Eastern Standard Time. London 2 to 5 a.m. and specifically the equity market opening hour between 3 and 4 a.m. New York time. New York, 8 to 11 a.m., and again emphasizing 9:30 New York time, specifically for certain markets, especially the indexes, oil, and gold as well, as we'll look at. And then the high of day, low of day, understanding the importance of major round numbers and the price behavior when it gets to these levels. Now, the 3 trades that I'll go over, I'll break them down right from the beginning, but I will emphasize again to have setups, not going to the screen and saying I'm looking for a trade at the high or the low. If it goes up, I'm going to sell the high, or if it goes down, I'm going to try and buy the low. That is not the approach. The approach is to have a process to identify your best setups. And again, I emphasize I want to work from the high and low, as we'll show. And then developing a thesis if this is one of my playbook best trade setups. And if it is a setup, is it a 1-star, 3-star, and 5-star? And typically the 5-star setups are going to be after Asia and London have traded. When I have all 3 sessions information on the board, or perhaps I'm at the high or low of the week or the month, if it's in London or Asia, peak formations, those sorts of things, as we've talked about in previous videos. But today we'll go over 3 specific trades that I did take. Now we're looking at gold, trade number 1, and this was on Monday. I'm not going to have any levels on here. We'll break this down even further, but we have the high of Friday, we have the low of Friday. When Monday starts. Now, if I put the colored boxes on here, we can see Asia, London, New York. And again, I'll just put my weekly separator on there. This is Monday. Now, when this trade is taken, I talk again, going back to the timing window. The 3-hour high and low of that 3-hour session gives you everything you need to know about developing your thesis. Now, the dotted line is our previous day's high and low. And in Asia, we had a market that went vertical from the low of Friday. And the short trade that I took in London. Now, if we come back and just go back to the original picture, we have the high of the day. We have the low of the day. Now, Asia has made a high and a low inside of Friday's high and low. But we'll also notice we're in a 100 pip box. If we've just gone up 3 levels, we've gone from the bottom to the top, that's 100 pips, it's 4 levels, but we've gone through 75, and the market pulls back after our 3-hour high and low, and in the gap time continues to auction higher, taking out the high of Friday. When the session starts, that is the high of the day. The last high prior to the Europe-London window is at that level. Now, if we just take that level and take a look at our left, we can see there is a peak formation at that level from last Wednesday's high. We're 25 pips above the double zero box. It's made a peak formation, but we've also gone up to that level. Now, when we go to the 1 minute chart, I want to just go back to understanding three levels: 25, 50, 75. But I'm not in my new trading hour. Now, again, I'm talking about coming to the screen and trading for 1 hour, give or take, after I'm in the trade. Now, we have three levels of rise, but it's gone through 75 in our 3 hour window. My session, no trade for me. I was not at the screen. I'm talking about coming to the screen here. The market puts in a low. When I come to Europe, the market has gone up 25, 25, and we're into the third level. Into the third level at that peak formation from a week ago Wednesday. Now, I want traders to observe and pay attention to this. When they go up three levels, start to identify space. The potential for a market to fall back after it's gone vertical, after we have taken out the high of the previous day. We've gone up three levels and another three, so the count begins again: level 1, level 2, level 3. The market in the first hour makes a low, goes up and hits the stops and auctions down. Now we'll blow this up. The market then, when London opens, comes down and pins through the low-hanging fruit at the open of the London session. First hour puts a high in, second hour puts a low in, and they come back up into the third level. They hit the stops at the high of the day on level 3. Level 3 then becomes level 1 for the trade. Three levels of rise. We have a stop hunt, beginning of London, so we have our high locked in. London makes a low and goes vertical into the high of the day. We've already taken out Friday's high. We've hit stops from the peak formation from last Wednesday. We've had three levels of rise in Asia, a new low put in, and another three levels of rise. They pull back, come back up into level 1. I want to get filled above 25, which is the third level, for a short trade back down to the low, or at least the level 1 where they put in the low, coming into the gap. The market comes back up. There's my trade. Anywhere up here on the pullback inside of the stop hunt, inside of the peak formation candle, I want to get filled above 25. Not about the 4 hour chart, the 1 hour chart, anything else. I'm getting filled above 25. My stop is going above the high of the day. And in this particular case, the high of the day is at 39. I don't worry about the spread or anything, because once I'm in this trade is either right or wrong, and putting a 2 pip spread in doesn't mean a thing, because it shouldn't even come back up here. So if I'm stopped out, I'm stopped out, but my minimum target is the low of London, my minimum target, and then 50 pips takes me back to the low of the first level of rise that they put in the gap after the 3 hour high low. 3 hour high low, but then they proceeded to put in a low and continue higher. I go up until the new window starts. There's my new high of the day on a third level of rise after the 3 hour high low. There's my trade. I'm done. Now, I know that the market can continue down. It can come back up. I don't care. That's my trade thesis. I'm short. I'm done. The trade is over. Now, coming back to the original chart, we're at the high of the day. During the London session, they hit the stops, 3 levels of rise, and I'm short in London. Later on, there was a long trade in the U.S. session back up into that short trade, but we'll talk specifically about that later. I'm talking today about 3 levels of rise and 3 specific trade examples and the difference between the two. I want you to understand, though, this is the high of the day. Well, we're going to look at the Japanese yen next and the specific difference between those two trades. Now, this was a long trade that I took yesterday on the Japanese yen. There were 2 entries. Talk specifically about that. More importantly now, what I want to do is back this chart up. We had a breakout of a 3-day consolidation of this market. And I talk about the 3 things that markets do. They break out, they pull back and they trend, they break out, marginal new high or marginal new low, and they reverse, or they break out, fail, and they stay in a trading range. Now again, just comparing the 2 charts, we have a high and a low on gold, and we have a high and a breakout on the yen. But what we also have is a 3-day consolidation and an ascending triangle. When I'm looking at this chart and the pullback, this is a specific setup that I'm looking for in Asia when a market has broken out. There's a high. There's a high. And what that is, remember we talk about this concept, okay? Anytime I'm going to the screen, what I'm looking for is where is the money. So this is a geometrical structure, an ascending triangle. Go and get those books, study them. There is nothing new under the sun. Nothing has changed. These markets are the behavior of people, herds, the psychology of buying and selling, chasing the moves, all of these things. So understand the difference between these 2 patterns and then breaking this down again into what transpired over the Asian session. So we have a 3-day consolidation. Now, I'm going to emphasize again to continue to realize the importance of the 3-hour highs and lows. That gives you an abundance of information going into each session. Is the high or low locked in? Have they extended that out further? All of these things. But again, the difference between a marginal new high and a false break and a breakout, pullback, as I talked about, we'll zoom in on this a bit more, breakout, pullback, okay, patterns within patterns. This is a geometrical structure. This is a rectangle at the bottom of the range. It broke out, pulled back, and went into consolidation. Strong moves come out of consolidation. Start to study these consolidations in the gap times and understand the importance. If the consolidation's down low, chances you might be going up. Consolidation up high, 3-hour window. It breaks out and continues to go higher before the next session begins. What that tells you is that the high is not locked in. They break out, they pull back. There's a trade in the 2nd hour long. The market was long before the session began. Now coming back to what we just looked at, there's money. They've already cleared out the lower high. There's money there. I used the 4-hour chart levels. It doesn't matter. It's all the same. When I came to the screen, they'd already broken the high. Traders said to me, I don't get it. You shorted the high yesterday and today you bought it. That doesn't make sense. There's 3 levels of rise. No, we're at level 1. We've come out of a consolidation. We are already in a breakout trade. The market broke out the day before out of a geometrical structure. There's a measured move on the ascending triangle for a long trade. They gave a first bar trade. They broke the high that triggers the first mouse. This is a first bar trade. A measured move of that structure itself gives two full range expansions and went straight up to these targets. I took my exit just off the numbers for a 40 pip explosive move. Now the second point I want to emphasize is this. A trader said to me, "Oh, that's interesting, we have different styles. I was waiting for the short trade on level 3. I am not looking to short a breakout market. Do you recognize the difference? Now, I'm not critiquing what any other trader does. I don't care what they do. I want to explain the rationale, though. This is a 50 pip move in 30 minutes. You're shorting a breakout market. This is a 50 pip move in 4 hours. Do you understand the difference? A creeping trend now in a breakout market becomes order flow for the continuation of that breakout trade. I want to trade in the path of least resistance. The previous day on gold, we're at the high of a day in a trading range after 3 levels of rise at the beginning of the London market, 25 pips above the 00 box, above the previous day's high after stops have been hit on level 3 for a short trade back down for 50 pips. This is an explosive move going after the money in a breakout trade. This is a counter trend trade. That is different from a reversal. This is a counter trend trade against a bullish market. I do not want to participate in this type of price action. I want to be in the explosion, be done, walk away, come back next session. Now the third trade I want to go over is the S&P from last night's US session. And if we look at the S&P and NASDAQ, both markets have had breakouts. Last week, large explosive breakouts out of monthly lows. When we zoom in and look at this market Monday, Tuesday, Monday proceeded to go higher but broke down yesterday in the Asian session. So again, marking off the highs and the lows. We can go back to Friday's high. We can see that we're in a market that Monday potentially may have put in a high before breaking down. Now, I emphasize that with the U.S. indexes, I am looking at 930 New York. I may have the odd trade in London occasionally, but my main focus is 930 New York time. So again, somebody asked me, what do you mean by a broken down market? This market has put a high in, and over the course of the day, proceeded to make lower highs and lower lows. Now, before we get to the New York market open, just for simplicity, we can mark our levels. We have the low after our 3-hour window. Okay, so I talk about the 3-hour high and low. The market went lower. It went lower after our 3-hour window. What does that tell us? It tells us that the low is not in place yet. But the level of this 3-hour window tells me whether they're working the low or they're working the high. Now we'll go over that in 1 second. So we project these lines across and we can see, okay, where is the money? We have stops underneath. Okay, and so again, understanding wherever there are swing lows and swing highs, there are stops underneath of those levels. Where those levels are, you can make a mental note, you can pencil them in, you can draw lines. I want to know what the level is. Now people, again, I'm going to emphasize the importance of the timing of everything. The time that you're in the trade, the time that the trade occurs, the timing of the highs and the lows. All of this is critical information to know what a best trade setup is. The best trade setup are the ones where I have the highest probability, highest conviction of a move being unidirectional for whatever, 15, 30, 45, an hour. And have the stops been hit? Where is their money? Where does this market have the potential to go? In the gap time, they put a high in place. This is before 9:30 New York. So coming back and looking at London, there is our low of our 3-hour window. What that tells me now is, have they locked in the low or the high? In the gap time, they go down and they lock in the low. There's my low of the day. This market's locked in the low. Except that before the U.S. session begins, we have 3 peaks. They now maybe have locked in the high inside of the gap. So we have a high and a low prior to 9:30 New York time. We have levels below that we marked off down underneath, which I've just marked in with the green lines. And remember, 9:30 New York time. And what do we see happen in that first hour? They come down in the first hour to the low of the day. They then proceed to put in a low in the first hour at the low of the day. We then start the process up. There's level 1. Level 1 is where they come out of the consolidation. Now remember, 9:30 is when the market opens. Level 1, level 2, level 3. We want to sell up in level 3, just like the London trade on gold the previous day on Monday. 9:30 is the key time. Once we get up into level 3, guess what time this is? 1 minute before the market opens. This bull candle, anywhere up here, is where I'm entering in the trade. Once they break down, I want to get filled anywhere underneath of this high. What is my thesis? My thesis is 3 levels of rise for a short trade, back down to the low not only of the day, but potentially to clear out those lower level stops where the money is. Now, this is where understanding time compression comes in. I'm in this trade. They take out the low of the day. As we get down to the bottom of this range, we are at the end of a 15-minute candle. The last 15-minute bar is about to open right on this little bar. We've just taken out stops. I am taking the money off the table. I'm out of the trade. I don't care if the market goes lower. I don't care if it comes back. Coming back to our thesis, 3 levels of rise. There's the escalator. Back up to level 3. We have the high locked in. This is what we want to see, the creeping trend back up to the top into level 3, which becomes our level 1 for the short trade, back down. So again, understanding the importance of the 3-hour high-low, the difference when you have the bigger geometrical structure in place. We already had the high locked in on Monday potentially. They made lower highs, lower lows. They took out the low of London. We had lower hanging fruit and stops to the left from Friday and Monday. The market proceeded up in 3 levels. It gave us our short trade right at the open at the New York session for a fast, explosive move back down to the low of the day. Out of the trade, done. Not worrying about trading all this other garbage. I'm coming to the screen at a specific time with U.S. markets looking for specific best trade setups. So hopefully that clarifies the difference between the 3. Understand the importance of the timings, understanding the importance of the geometrical structures, understanding the importance of 3 levels of rise or fall, and the difference between an explosive move versus selling at the high, buying at the low, and holding on to something for hours on end and sitting through up and down movement where you can't really put any size into those trades. And you have to sit there and stress, I want to be in the move, be out, be done, walk away. Hopefully that provides value to you traders, and you got some gold nuggets out of that will help you get better, make it a great day today. Keep it simple, manage your downside, lock in the profits, and may the markets go with you.